Order set. Welcome everybody to our Tuesday members meetup for August 31st. What I'm going to do today is, of course, we go through the walkthrough. Then I'm going to be talking about our Apple trade, and I'm going to go step by step through that trade and what we do time and time again. Okay, so this slide and the next slide, you can always come back to this webinar and you'll have it right here. These are the two things that you need to be locked in your brain to do over and over and over and over and over and over and over again. Okay. And you will become a success. It will take a while for you to get this locked in. You're going to have losing streaks. And that's one of the things I hope that everybody goes through and learns, to just stay with the program. Just stay with the program and execute. This is a positive expectation trading strategy. Okay. So the walkthrough basically is that we use the regression channel. And if the price is around the 1 or the 2, either plus or minus 1 or 2, I'm interested in, but I'm looking for the price to revert back to the mean. I always want a measured move to confirm that. And a measured move, a bullish measured move, is a higher high, a higher low followed by a higher high. As long as you continue to have higher highs, you are in a up bullish trend. On the other side, if you're in a downtrend and you have lower highs followed by lower lows, you are in a downtrend. As long as you continue to have lower lows, it is in that downtrend. Okay. So the measured move, if you didn't get in the first one, that's okay, because if it's in a trend and it pulls back and then makes a new measured move, I ought to take this out, really, because the measured moves are the things that I'm looking for to enter a trade. And the nice thing about this strategy is you shouldn't be worried about, oh, what happens if this is not a good setup, and what happens and what happens if this goes the opposite direction, and every time I put in a trade, it goes against me. Well, the beauty of this strategy is that you know when you're going to exit before you enter. All right. You're going to exit when you get a measured move opposite the trade, or the 5 crosses either above or below the 8. That's going to be your exit. That's going to be a losing trade. We're going to have about 25% of those in the long run, statistically. Okay. What does that mean? Well, it might mean that we go through about 5 or 6 losing trades in a row, because statistically that could happen. So, prepare for that. This is no big deal. Prepare for that. And we go back to the trade size for your portfolio. Don't overtrade your portfolio and you'll be just fine. Now, as far as taking a profit when it's going with you, I usually look at the Fibonacci's, and you can preset these to record a profit. Okay. Sometimes I'm looking for support and resistance, and sometimes I'll let a trade go a little bit longer, and that's what the alerts are all about. And we're going to review some trades today on Caterpillar, and I'm going to show you exactly when I got in, when I got out, and why. All right, but this is for the new people. This is exit with a loss when you get a measured move, or the 5 crosses the 8 opposite the trade that you're in, or when you get to around a Fibonacci price of 127, 161. All right, so this is how you get in. This is when you get out. All right. So you've got a trade set up and you're getting ready to go. And first of all, you want to choose the proper option chain. Well, if it's a weekly trade, of course, we're using the SPX only for weekly trades. I want to put a trade on only 10 days until expiration. 10 days till expiration. All right. If it's a monthly, I want to use about 30 days till expiration, and monthly is going to be Amazon, Google, RUT, and the SPX. Those are the big boys. And you only have to go out about a month to get good credit. If it's a leap, I want to go out about 100 days. Now, why the difference here in the length of time? I want to get about $1.50 worth of credit. And in order to do that on a leap, I usually have to go out about 100 days. For a monthly, I usually have to go out about 30 days. And for a weekly, I'm going to go out about 10 days. Now, a weekly, I'm going to only have a 5-point difference between the strike and where I buy. So I'm only going to get about 75 cents. But if it was a 10-point difference in strikes, I'd get $1.50. $1.50 is kind of my target. Okay. So then you want to choose a strike price or for the option to sell. Well, the easiest thing is to look on the delta and look for something around 0.2. 0.2. That means that trade has about 80% chance of winning. Or if you want to get implied volatility in there, and this is the way I do it all the time, for a bull put, I want to subtract the projected move based on implied volatility from the current price, and that is my sell strike price. For bear call, I want to add that projected move. Okay. Now, like I had mentioned, you choose the strike price for a weekly 5-point spread, 10-point spread, and 10-point spread for monthly and leaps. You always want to check for open interest. And yeah, I know we just put in a Google trade and the open interest was only around 50. Well, believe it or not, Google has interest, but they usually don't have huge interest. I like them because they give very nice credits. So I was okay with going in with an open interest of about 50. This is a kind of a these can sometimes vary, but I like what this basically is saying is you've got enough people in there that if you want to get out, you've got some liquidity, you've got some people in there that probably buy that option back from you, buy the vertical back from you. All right, once you have that set up, you want to right click on the option to sell, click on sell, click on vertical, make sure you got the quantity and the spread correct, click on the midpoint, confirm and send, and read over your order. All right, so let's go over this on our Apple trade. Apple made a measured move right here, okay? And I sent out a text and email alert to get into Apple. And how did I decide which one to do? Okay, you come over here to the trade tab. And I want to go out about 100 days until expiration for this leap. Well, could have gone to the December, but I decided to go with the November. How do I decide what strike prices to sell? Well, I want to go about 0.2. Okay. The other way to look at it is I went with 152 minus 17 or about 135. So either here or here. And I decided to go with this one to be a little bit more. This one would have been totally conservative. This one gave me a little bit more credit, so I decided to go with this one. Okay, so you click on this. You're going to sell. We always sell. We're sellers. A vertical. Okay, you want to make sure it's 10 points apart because this is a leap. You want to make sure your quantity is correct. You come over here and you say, okay, this is the midpoint. This is where I want to put my order in. You confirm and send. Read this over. I want to sell the quantity I want, a vertical for 19 November, the 140-130 put vertical spread. That is correct. Okay. Confirm and send it. I already got one on, so I'm not going to send another. Well, nah, I won't do that. Okay, and that's how we got into the Apple trade. All right. So once you've sent this, I want to go ahead and delete this. Once you've sent this, you can come over to the monitor tab and watch it right here under working orders. And it'll tell you what the status is, what the current mark is, and what your price is. Now you can watch what's going on right here. All right. Down here, it's going to show you, okay, what we have is we have a leap, a bull put in Apple, Abbott, and Danaher. If you come over here and you click on, if you right click on that, excuse me, if you left click on that, it's going to show you what your trade was when you got in there. Okay, we got in for $1.30 on Danaher. We got in for about $1.21 here on Abbott. And for Apple, it was about $1.40, $1.41. Okay, so those shows you the price you got in. Google was about $1. This says $1.50. Okay, but then you look at this and you say, okay, this is how much money I've made based on the number of contracts I have. So the first thing you do is you look at this and say, I'm doing pretty good. I'm doing pretty good. All right. So let's see what I need to do to manage this. All right. So the first thing you want to do is you want to take a look at the chart, and let's take a look at the chart of Apple. Okay, Apple had a nice little rise. It's coming down. The 5 is over the 8. There's no reason not to hold this. Look at where I always put a channel in here to show me where the option vertical is. We've got support right there. We've got support here. We've got a lot of support here. Okay, and notice that Apple's in an upslope. So the longer we're in this trade, the more conservative this trade gets. And that's to our benefit. So everything looks good here. Now, the other thing I want to do is I always want to go over and take a look at the risk profile. This is a risk profile for a bull put. All right. And the red hash mark is what we bought it for. This is the break even. This is the break even. This is where we're at right now. The black is where we're at right now, and we're down a little bit. It's okay. We're down a little bit. Let the trade go. I always put this at about 6% of margin. 6% of margin on this trade is about $600. So as long as I am into the right of this, I am making profit, and I just let this go. Okay. Now, if you do get a measured move, you might want to just check this and make sure, yeah, am I in trouble? Should I get out? Okay. And especially for the new people, if it makes a measured move, just go ahead and get out and be on the safe side. But the risk profile tells you exactly where you're at in the trade and whether you need to be focusing on this trade or whether you can just let her go. Right now, you can see Apple is just let it go. Just let it go. Okay, so we have Apple. We have, let's just take a peek at Google. Okay, Google, let's see, 6% of Google would be right about there. Okay, you can see where we're at on Google. Well, let's see, where is the, yeah, here's the black hash mark. We're way over here on Google. Well, what's this telling me? I have very little profit left in this trade. I've got the lion's share of it already. So right now, when I look at this risk profile, the first thing I think about is it time to take this profit? So I come back over here to the chart on Google, and I take a look at this and I say, yeah, we got in on a measured move. It's been going straight up. The 5's over the 8. It looks really good. We've made most of the money. I look for about 10% of margin as my profit target. 10% of 10,000 is 1,000. We're there. So then I come back to the chart and I go, this is so strong. This is so strong. Why not let this go a little bit? So, it's a beautiful decision to be in. I've made exactly what I want to make. But it looks like it's a strong trade. I don't see any resistance or anything that would worry me here. So I might just let Google go. On the other hand, I might say, well, okay, I've had my profit, but for right now, I'm just going to let it go. I'm just going to let it go. Okay. The other one we have is Danaher. Danaher's down a bunch today, but look at where our vertical spread is. We are way, way, way down here out of the money. And Danaher has been going right up this regression line. Yeah, we had a little bit of a down day today, but my goodness, that is a very conservative trade. So I'm not worried about that at all. The 5 is still over the 8. Let's take a look at the risk profile for Danaher. Okay, let's see, the 6% on this guy would be right about there. It's to the right of the 6%, to the right of the break even. We're making money in Danaher. It's having a bad day. Let this go. Just let it go. You gotta let your positions go. Steve, I see your hand is up. Let me unmute you real quick. Oh, by the way, I see some new people in the audience, and that's great. A couple ways you can ask a question. Most of the people type it in the question box. And then you got people like Steve that likes to talk to me directly. So he just clicks on his little hand, it comes up, and I unmute him. Steve, question, comment?
Yes, can we go back to the Danaher chart?
Sure.
The one thing that would lead me to think it might be time to consider getting out, look at the 1-year weekly chart. It's at the +1.
Yes.
Now, the last time it was at the +1 was back in October, and it took a dip down. So
yes.
Tell me if I'm wrong in looking at it that way.
Yeah, that's good information. That's good information. But this is the screen that I trade from. And what this is telling me, Steve, is that the 5's over the 8. I have no major move against it. The risk profile shows that I'm making money. I'm to the right of the break-even point. I gotta let trades go, let them evolve. So I'm in. I'm staying in.
Okay. I guess the biggest thing you look at is that all the cushion you have between the present price and our strike price, right?
Yeah.
Okay.
And that's how you get when you go in and you set up and you decide this is the strike price that I'm going to sell. That's going to be around 0.2 delta. So you've got an 80% chance it's not going to come to this point. And that's the kind of trade I like. I like a very conservative trade. Now, a lot of people, a lot of people will move this up and say, okay, I'm going to put it right here. And, I like a high win percentage. I like to be conservative. Yeah, you put it right up here and you're gonna collect maybe $3 or $4 credit versus the $1.25 we got, but I'm okay down here. But
I got you.
no, Steve, this is, yeah, it was here and then it took a dip. Yeah, that's okay. And now it's here again. But look at the move it's made. I mean, it's made a nice little move and it is going right up this line. But the biggest thing is the 5 is over the 8. We have no major move against, and the risk profile shows that I'm making profit, so let it go.
Okay. Thank you.
You're welcome. You're welcome. Good question. Good question. Okay, Gary. Gary says, can you show us the trade volumes again, for the verticals, especially on the put vertical side, the trade volumes. Let's go back to Apple, and you can look at. Let's see here. You see right here on the layout, I have. If you click here, you can customize this, and you can get in here and look at trade volumes. Let's see there's volume right there. Volume to me, I really look at this guy, which is the open interest. That's the one I'm interested in. Okay. And that tells me all I need to know. If the open interest is above 100, I got plenty of liquidity. Liquidity is the only thing I'm worried about, Gary. And if I've got good liquidity, that checks that box, if you will. Okay. Chris, how you doing? It says, when confirming the position with the 5 and the 8 EMA, you're only using this on the daily chart, correct? That is correct. That is correct. This is on the 1 year week chart. Each one of these bars is a week. This, like the discussion Steve and I just had, this is really a grounding tool, if you will. This is okay where it's been in the past. Yeah, it's in a nice little uptrend right now. That's really all I'm looking for. And then I come over here and this is where I make my trade. Okay. But the 5 and the 8, you can see I only have it on the day chart because I learned way back from a floor trader that they follow the 5-day exponential moving average. And you'll notice that a lot of times when a price is trending, it goes right up that 5-day exponential moving average, just right up it. It's a beautiful thing. And then when it crosses below the 8, it's like, well, okay, in time to maybe watch. But now the 5's over the 8. So this would not make any sense to me because a 5 and the 8 chart here would be 5 weeks. That doesn't have any, I was taught 5 days is the line that they watch. 5 days. So if I look at the weekly chart, and it's a 30-minute chart. A 5 here would be 5 30 minutes or 2.5 hours. That doesn't have any meaning to me either, because, well, like I said, I was taught that it was 5 days. And I have watched this for a long time, Chris, and it is just uncanny how the 5-day will keep you out of trouble. Okay? Okay, good deal, good deal. Alrighty, let's see. So I went over Google, we went over Apple, then her Abbott. Did we take a peek at Abbott? Abbott, once again, look how conservative we are. And look at this. When we first put this trade on, it was between the -1 and the -1 and the -2 on the regression channel. And now it's, as we make profit here and it goes up, we're getting more and more and more and more conservative, which is, it's a beautiful thing, to be more and more conservative as you get into a trade that's working. So let's take a look at, Abbott, the 5's over the 8. If it comes over here, it's making another major move to the upside. Let's take a look at the risk profile on Abbott. We're right here. There's the 6% right around here. We're to the right of the 6%. We're to the right of the break-even point, and we are making money to the point where it's almost time to say, that's okay, we've made enough. Let's move on to the next trade. Okay. So we have bull puts on Abbott, Danaher, Apple, and then for Leaps, and then we have a bull put on Google on the monthly. Okay, so let's just take a peek. Did we see anything on the weeklies? Okay. Made a measured move, measured move, measured move, and a measured move, measured move. And now it would need to go above here to make another measured move to the upside. So, and I didn't take any of these. I didn't take any of these because, this one would have been a very nice one to take, believe it or not. But I was involved in a trade at that point and just let it go, and it turned out to be a profitable thing. But if we come back here and put a Fibonacci on this guy, remember, click to the high, click and drag down to the lower high. See, and this blew right through the 161. So if it blows right through the 161, I'm looking at the next target, and that's the 261. Well, it got there. It got there. So at this point in time, this could be like a little consolidation period. Yeah, indeed. It's running right up the regression line. And this would be another measured move, but I would need to see that measured move before I get back in there on a weekly. Now remember, a weekly, you would come over here to the trade tab, and you would go out about 10 days, okay? You go out to 10 September. And the easiest thing to do is look for 0.2. There's a 0.2 right there. And I want 5 points apart. So I'd sell this one, buy this one, 60 cents. We're looking for about 70. So maybe I'll get, but it's interesting because, this one is about 60 cents. This one's about 60 cents. Then it's 70 cents. So I'd stick right around this area here, but not yet. Not yet. Chris, the only reason I trade SPX weekly is that SPX is a huge value, if you will. Okay. Most of the stocks in the financially strong are only like $200, $300 a share. All right. This is $4,500 a share. So I'm saying I'm only going to hold this for about 10 days, but usually only about 4 or 5 days. And I need to trade a really big guy to give me the credit for such a short period of time. All right. Let's go over here and let's just take a peek. And we'll take a peek at John Deere. John Deere. 10 days from expiration. Let's say it's at 378. I want to look around let's say 360, something like that. 360. Okay, and then I would sell a 350 or buy a 355, and you can see I would get about 30 cents worth of credit. Nope, no thank you. I don't want to do that. I don't want to put on a trade that's got 30 cents worth of credit for a $5 spread. It just doesn't make any sense. Okay. I need something that has a lot of credit, and that is the SPX. Yeah, you can trade other things. But I would keep it. I would keep it to these big boys. Maybe Amazon. You can do that. The only thing with Amazon and Google, you're going to find a little bit less open interest. I mean, let's take a look at Google. 10 days out. Let's see, around 0.2. Around 0.2 is what I'll be looking for. And so I would sell this and buy this. And that just barely has enough open interest. It has 70 cents worth of credit. So yeah, I would be okay with that. But look how big it is. All right. It's 2,900. It's not 290. It's 2,900. I just did a one-on-one seminar with a person from Canada, and they don't have Thinkorswim yet, and he's still paying relatively high commissions. Boy, I remember those days. And to him, it's very important. I mean, to put on a trade that only had like 30 cents worth of credit, and then you take commissions off that, that just doesn't make any sense at all. You need a lot of credit, especially if you got higher commissions. Okay, good deal. Good deal. So let's see. What I wanted to do now is take a look at some previous trades I made on Caterpillar. And let's go over those. I want to go with Caterpillar, and I'm going to go with the daily chart, and I'm going to maximize this. And I want to change this to a year. Okie doke. All right, so let's go back through and take a look at these Caterpillar trades. And I want to go all the way back to October 7th of last year. Let me blow this up a little bit. October 7th of last year. Okay. October 7th, we had a measured move right here, right there. All right, we had a measured move right there. I got in with a 15 January and I sold the 130 and bought the 120. Okay. And then I came back here and put in a Fibonacci, and there's the Fibonacci of 127. Well, right here, it hit 127. Okay. I got out of this trade with about 11% profit on margin, which is beautiful. Okay. This is like a picture perfect trade. Okay. So let's go ahead up here. Let me bring this down here. So the next one makes a measured move right here. And so I waited, that was a big move up. I waited a day and said, okay, yeah, okay, it's gonna hang in there. So I'm gonna get in. And I get in with a 19 February where I sold the 145 and bought the 135. All right. Now, with vertical spreads are beautiful because if I would have had a straight call right here, I would have got in right here and I would have got out right here and I would have lost a lot of money because it didn't go in the direction I was looking quickly. Remember, each option has intrinsic and extrinsic value. Intrinsic value is time value, okay? And every day the trade goes by, that time value is lost. So even though it had a little bit of a rise between when I got in and when I got out, it wouldn't have been enough to compensate for the loss in value of time due to time. With a vertical spread, time is our friend, okay? The longer a trade goes, the better we are because theta is coming off. And the ones that we're selling down here have no value. They only have time value. So the longer we're in a trade that goes sideways, the more money we make. Okay. So you remember with a vertical spread, you can make money if it goes in the direction you're looking, if it goes sideways, or even if it comes down a little bit. In this particular case, we held it for quite a while. And finally, I got out here when it dropped a little bit. And, you know, I held on this for a long time. You say, well, you had it for 100 days. Yeah, I did. But you know, I guess I thought, well, you know, I've made about 7% of margin. Why not get out? So I did. All right, moving ahead to the next one that occurred right there. Okay, we had a measured move that happened right there, right? Everybody see it? And then based on the Fibonacci's, there was the 127. I had a target even before I put this trade in, all right? And what I did is I sold the 16 April 220. No, I have this written down. Oh, I'm sorry, I missed one. I'm looking, I said, I sold a call there. That's not a call. Yeah, I'm looking at this one. 16 April. No, yeah, this was 120. Yeah, that's exactly right. We had a measured move right here to the downside on an uptrend. We had a measured move on the downside. All right. And I got in right here the 16 April, where I sold the 220. Excuse me, I sold the 210 and bought the 220. And then it came to the 161 and I was out. Well, the other thing is I only had 3 days before earnings. So I was looking at this and I was looking at this and I said, thank you very much. I got out of that trade at another 11.5% of margin. Okay. Then we had a move up, pull back, measured move right here. Time to get in. Time to get in. Steve, I see your hand is up. Did you have another comment or a question? Let me unmute you. Steve, is your hand getting tired or was it?
No, I have another question on the
Okay.
enter at a measured move.
Yeah.
There sometimes you enter the day and makes a measured move, and sometimes you wait a day in your own words to see if the trade's going to hang in there. What's your criteria for that? Could you expand on that a little bit?
Yeah, I guess that's just experience, Steve. I mean, you know, when this one happened right here, it made a measured move. It opened on a measured move. I kind of let it go through half a day just to see if it was going to continue on. Sometimes I do, like this one right here made a measure move and I got in as soon as it clicked. Well, the next day it was up a little bit. The next day it was up a little bit. And then finally, it was, you know, so I could have waited a couple days here, but, you know, I got in here and it was 1, 2, 3 days before it actually worked in my favor. I don't know that there's a rule of thumb, Steve, that I use that if this happens, I wait a day. If this happens, I get in. It's just kind of a gut feel from doing this for many, many years.
Okay, I would think that if you're at a plus or minus 2, that you, I really don't know. Uh, I guess I got to get more experience in, huh?
Well, I mean, this one was going right up the regression line. Okay. Um, when this one made a major move to the downside, I was thinking this is going to be a short one. This is going to be a very short one because everything's going up, and now all of a sudden we had a major move to the downside. So I might only be in here a day or two, so that's why I jumped on this one right away.
All right, that makes sense. Okay.
Okay.
All right, thank you.
Okay. So, I don't know that I have a hard and fast rule on that, Steve. Sorry. Okay, then we come up here, and this one was 216, and you can see this major move happened here. I think I got in about here. As soon as I got in, I had a measured move. As soon as you have a measured move, you can put in a 127. I had this 127 put in here the day I put on the trade. I knew that if it got to this point, I was going to get out. Well, bingo. Did I leave some on the table? Yeah, I probably did, but was I glad I got out at this point? Yeah, yeah. And this was only a 7 days, 5 trading days, and we made 72%. Well, 7.2% of margin. Okay. So now these were all winning trades. There's a lot to be learned from losing trades. So next time, what I'm going to do is I'm going to go back through the records and I'm going to pick out some of my clunkers. And we're going to look at some clunkers and talk about why I did what I did. And like I said, you can learn as much from losing trades as you can from winning trades. Let me whet your appetite a little bit. Wait, and a lot of you were with me and went through the anxiety of our Home Depot trade back here. Let me blow this up a little bit so you can see a little better. Okay. Okay. Well, actually, I want to come back over here a little bit. All right. So I entered this trade right here. And so why? Why did I enter that trade right there? So scratch my head and, you know, look through my notes, and I said, I thought I was a measured move. Well, no, it wasn't. It was not a measured move. And also in my notes, it said the 5 crossed over the 8. Yeah, it did. The 5 just crossed over the 8. But like I was saying right at the beginning of the webinar, is to get in, I would rather see a measured move. It's a stronger signal than the 5 crossing the 8 to get in. All right. To exit, the exit is the 5 and the 8. I watch it very closely, because if I have a bullish trade on and the 5 crosses below the 8, I am out. I am out. Okay. So the reason I got in right here was the 5 crossed over the 8. I didn't have a measured move. I was probably hoping for a measure. Oh, hope. Geez, that's not a good. That's out of the vocabulary of trading. Because hope can get you in a lot of problems. Hey, Les, I see you say, oh, our last John Deere trade was a clunker. That's good. That's good, Les. Do you remember what day was that? Do you remember? Was that in April? If you got a record of that, yeah, we'll definitely take a peek at that one. Yeah, we'll definitely take a peek at that one. Okay, so we stayed in here. I stayed in here, and okay, and I stayed in for earnings. What the heck? Come on, Dale. So there's 2 strikes against me. I didn't have a measured move. Yeah, the 5 was over the 8, but then the 5 crossed below the 8, and then I had earnings. I still stayed in. And the reason I stayed in is because we're getting very close to the -2 on the regression channel. Well, we sold it for $1.48 right here. And boy, there was 1, 2, 3, 4, 5, 6, 7, 8, about 2 weeks of anxiety. I hate anxiety. I avoid anxiety like the plague, because I know that if I'm to stay fresh and stay focused on trading, it's going to require 100% of my focus, and I can't be nervous about a trade. I can't have anxiety. I can't have second thoughts and doubts in my head. And this trade was a yikes. I looked at this when it had earnings. I said, well, okay. I didn't adhere to my own teachings. So now what am I going to do? Well, it's close to the -2. All right, I'm going to let it go to the -2. Really? Okay. At this point in time, my option was worth $3.87. So we were down considerable. We got in at $1.48. We were down to $3.87. And then it turned around. And people say, well, man, you were awful lucky. You were, oh, okay, thanks, Les. 413. Let me write that down. 413. Yeah, and we will definitely take a look at that next time. Thanks. Oh, Saul was answered that. Thanks, Saul. You both were in that trade, obviously. So you say, boy, were you lucky? Well, yeah and no. I mean, how many times did it come down to this -2 and revert back to the mean? So I had already lost a boatload. I already lost $2.39 or 24% of margin. Yowza, that's going to hurt my statistics. So you can see the anxiety, but then it started working, and then it started working. And then the 5 crossed the 8, and we were moving up, and it started working. And then we had a little measured move here, and I did a Fibonacci on that, and lo and behold, 127 was right here. It came up there, and I was like, thank goodness I'm out. And I collected 15% of margin. Well, for the new people, you shouldn't have gotten in here. That's one. You should have gotten out as soon as it crossed over. That's 2. You should have gotten out at earnings. That's before earnings. That's 3. You could have been out right here, and that would have been just fine. Okay. And so you would have avoided all this. And that's especially for the new people. You want to avoid all that. Now, I've been doing this long enough that I've got the utmost confidence in this little gold line right here. And I stay with it, and it worked out to my benefit. And that was it. That was it. Did we have 2 trades on? And Saul's saying 413, and Les is saying 420. I'll have to go back in my records and check that. If we made 2 trades, I can see that probably was a clunker. Okay. All right. So that's what we're going to do next time. We're going to learn from my clunkers, from my mistakes. Fred, I see your hand is up. Let me unmute you. Fred, can you hear me?
I can hear you. Can you hear me?
I can hear you fine.
Okay. I'm going to, I don't usually make this type of suggestion because it builds you up too much. But if I have a suggestion, especially for the new people and the old people like me, if you will make a copy of the first 2 scenes that were up there on your computer, and I have in my records, it happened, we started talking about the walkthrough at 12:02, and if you will listen for the next 30 minutes and look at those, make a copy of those 2 charts and listen to the explanation, you are really, really ahead of the game. And if you'll put those up in front of you, those 2 charts, and listen to the first 32 minutes of the program this morning, you're going to be well ahead of any place that you want to be, especially if you're new. So I just make that suggestion to you.
That's great, Fred. That's the reason I did it, because I have some new people that have come in just recently, and some of their emails, they were talking about, trade execution and all that kind, and why do you use the SPX for weeklies, and why do you just use the big four for monthlies and so forth. So yeah, I did want to do that, and I'm glad it came through loud and clear, Fred. So thank you very much. Okay, good deal. Good deal. Okay, so that is that's all I wanted to talk about today. We are going to get together. Let's see, that's going to be September 14th, the week after Labor Day. September 14th. And I already know I've got two clunker trades that I'm going to look at, but we'll take a look at a bunch of losing trades and why we lost and what we could have done different. Okay. So, in the meantime, any questions you have, don't wait till that next webinar. Just send me an email. We'll discuss them on an email. Until next time, good trading. Bye-bye now.